It's Sunday, the 11th of February 2018. I don't normally do these updates on a weekly basis. The main reason of that is generally just I find there's not enough to talk about to justify doing them. But this week's obviously an exception with the falls in the indices across the world and how that's sort of coming into the gold price as well. So gold has held up okay this week. It hasn't attracted that safe haven buying that perhaps might have been expected. It's held up. It's down about 1.5% compared to those broader indices down sort of 6-7%. I think it's a bit of a crucial level. I think last week I said maybe this 1320 zone, we come back and test that. It did hold that level roughly, and that's kind of where it's trading at the moment. There's a bit of sort of historic support here at this level. This 1300 to 1310 I think is crucial. If we can't hold that, then you're starting to head toward this 1270 and maybe this lower trend line here, which comes in around the 1260, 1265 mark. But in general, I think it's holding up okay. With the extreme volatility, there's a few theories that gold is kind of trading in the same way that it did in 2008. That period was what should theoretically be quite strong for gold. It didn't perform very well. It fell sort of 20 or 30% with the broader market. And I think the rush in the immediate volatility of one of these events, you see that rush into US dollars and that rush into and those US dollars going back into the treasuries market. And that's sort of we see this feedback loop where bond yields are high, and that's what's causing the stock market to sell off. And when you see that severe sell-off, people flood back into bonds because that's a traditional safe haven, and that sort of calms the market. The stock market calms off, and then it starts rallying back up, and bond yields start rallying again as well, and then the market sells off again. So you see this constantly happening, and I think that happened all of the last week, and that once that sort of effect wears off, and people start to realize that maybe the bond market is also in a bit of a bubble. Not a bit of a bubble, it's a huge bubble if you look at it. And maybe that starts to see a rotation into some other asset classes, and I think that will generally be positive for gold. So in 2008, that period was 6 months, but the next 3 or 4 years was obviously a tremendous rally in gold and gold stocks. So at some point, I think you're going to start to see that rotation into gold here, because a lot of people are a lot of funds are underinvested in this, and I think they'll want that traditional safe haven. But that's you can't predict what's going to happen, obviously, but history has shown that gold will attract that money eventually. But in the severe volatility events, maybe it's not a good hedge in the short term. So yeah, potential I think for some downside there in the immediate future, but it's still holding on to that 1300 level. But I'd be a bit more bearish if it broke down through 1300. The S&P 500, obviously, just ridiculous chart here. It's amazing to see it fall off like this. I mean, I think last week I predicted that it was, we're going to see some more pain, but I wasn't expecting that. Those two 4% moves in a week is extreme by any historical standard. It's not. I know a lot of people were quoting, the absolute numbers on the Dow and the S&P as largest one-day fall ever. That's largely irrelevant, but 4% moves are not irrelevant in the scheme of things historically. And to have two in a week, that's kind of maybe that happens once every 10 or 20 years. I haven't looked up the stats, but that would be my feeling. And we haven't really seen this perhaps since 2011 when the US debt ceiling crisis was happening, and then in 2008 obviously as well. But here we're seeing here we're in this channel, and we've obviously reached sort of the end of the bottom trend line again. So there's not a lot. The problem with this chart and the way it's marched up, there's not a lot of support levels here technically. So it can keep slicing through. And I mean, I think last week I said 2700 perhaps, and that was nothing. It just went straight through that. And you can see the extreme volume here. On the weekly chart, I think it's even more obvious. That was second highest volume ever there. I don't know what this event was here. Maybe that's an outlier, but this is, clearly extreme volume. and to me, you got to sell. You're going to have to. This is going to take a while to play out here, a few weeks at least, before you're going to want to see some solid buying around and some sort of absorption of that selling, because I think there's a lot of people who are going to be spooked here and are going to be trying to sell rallies. It rallied all right on the close on Friday, but still not with particular strength. One thing I was looking at was the 2000 tech bubble. If I can just bring it up here. So, I mean, this is a similar sort of condition to what we've seen here. I mean, that market was rallying for 7 or 8 years. And then, when you have these channels, when you start to poke out the top of the channel and you start to go a little bit parabolic, and it didn't really happen here, but it did poke out a bit. And then I've read about this. I wasn't trading markets at this time, but saw that big one-day candle there to the bottom of the trend line, the lower trend line. It's not one day; it's a 1 week candle there, but that was a fall of about 10%, and that sort of marked the top of the dot-com bubble. I've read that sort of March 2000 period, April March. So I think that's the most similar here, and then it sort of rallies for sort of bouncing up and down for another six months maybe before it then sold off heavily, and that's the most similar sort of market condition that we have now in terms of valuation. Obviously, the dot-com bubble is the only period in history with higher valuation, overvaluation than what we have now in the broader market. So maybe we start to see a bit of a rally here back toward the top of this trend line, but I think this is the top now for on a monthly, yearly sort of time frame. I think this will mark the top looking back, but obviously can't predict that. But historically, a sell-off like this is not going to just go away, and the trend's not just going to return. I think people have been conditioned to this buying the dip when you have these sort of 3-5% down moves, but this is a late cycle move. We're 9 years into it, a bull market here. So the longer you play that game, you're playing with fire, and I've been saying that for a long time in these videos. Yeah, sure, if you can trade the market, there's still good money to be made, but I think people are going to be selling the rallies. Dollar index chart, not heaps happening in this chart this week. Probably put it in the daily there. Rallying back toward this key sort of former support level, which I think now should form the resistance. So around that sort of high 90s level. And my prediction is that it fails again there, and then we start trending lower. In these videos for probably at least the last 6 months, I've been talking about this analog in the last rate hike cycle in the US. And we had this rally here, which I was saying was equivalent to what we had 2005. Broke down obviously out of that, and then we were going to have this consolidation period, which is what we had in the back half of 2017. And then obviously we broke down on the low side, and now you start to see, I think, that stepping pattern lower. So when it breaks down, it's going to rally back up to that lower, what was formerly support, and now I think should form resistance before we start trending lower. I'm not saying we're going to go all the way back down here, but historically this has been and it's not just on the dollar index. This is pretty classical sort of charting when you break down support levels and then rally back up to test them. And I don't see what the catalyst is going to be here for the US dollar. If we had if we had a 2008 style event where there's money just flooding into to bonds, you could see it rally more, and that maybe the chart doesn't matter as much, and it's more fundamentals driving it. But in the short term, I don't see any reason why this should rally back up past that sort of 90-91 level that it's trading at now. Some of the other things, the spot gold in Australian dollars still hugging this lower trend line here. See obviously that volatility, Australian dollar selling off a little bit this week, and that's supporting the price. I think Australian dollar gold is flat, so that's supportive of the profitability of local gold miners. And I think if the market keeps selling off, in my mind, the Australian dollar will be sold off more strongly than the US dollar gold price. So you should see this chart continue to rally higher. And I've pointed out in these videos previously that when Australian dollar gold rallies, it rallies in those really sharp bursts for 3 to 6 months, and that's what we've seen. I think about 6 to 9 months ago, I called this I was looking for Australian dollar gold 2000 before the end of 2018, and that's still my target. But obviously, it's going to take some sort of severe economic weakness in the local economy for that to happen. But I think that's eventually going to play out. But and when it rallies, it'll rally very quickly. So you want to be set in those gold miners before that happens. But so as I said, spot the Australian dollar coming off very strongly here. Not a lot of support. Obviously, a lot weaker than the gold price here too. And I think we're going to be heading back toward this lower trend line here around this 75.5 sort of level. Potentially, maybe it finds support here at this former support level around 78. But I think if we continue to see selling in global markets, this 78 level will be sliced through. And some of the numbers coming out of the Chinese market were extremely poor this week as well. I think on Thursday they had their biggest one-day fall in the last few years. And the iron ore price I think is again coming off strongly. So factors that are traditionally supportive for the Australian dollar, I think, are not going to be there in the short term. So I'm expecting that to come off even further. GDX, really big candle forming there on Friday night, down. So that was probably down about 4% intraday, rallied up right at the close there on big volume. That's looks like it's the start, at least the start of a bottom, and perhaps a big reversal signal. The hammer candle, even though it's sort of regarded as being a bit of a big reversal, is not necessarily, if you look at stats on candle patterns, doesn't always mark a reversal and is actually more likely to be a continuation pattern. But when you see it on high volume, that was the highest volume for the last 9 months on Friday night at the end of a trend. And I think with the gold market sort of fundamentals in the broader market, this looks like a perfect reversal, even if the stats don't necessarily suggest that those hammer candles always mark reversals. But that looks, especially at this important support level around this 21 mark as well. So that looks very good here for a bit of a reversal and money coming into the gold stocks. Same on the juniors, the GDXJ, not quite as impressive, but again held resistance around that 30 mark there, held support at 30, and looks like it wants to rally a little bit here, or at least hold this line. Maybe you see it start sort of a couple of days at this 30 level, but potentially a good bottom forming there in the gold stocks. So that's sort of where I've been looking this week. Obviously, it's been a very sort of exciting market for people who are sort of very interested in markets. This is great, traders. It's been really boring for the last year, frankly, on these indices, and the rise of sort of passive investing, and to see a bit of volatility and excitement for traders is good. And I think that's going to be the theme of 2018. Whereas previously it's been passive for the last 2 or 3 years, but now it's active investing, trading, and risk management, extremely important here. And how that plays into gold, I think, will generally be pretty positive due to its sort of, that's historically where gold shines, is when there's that uncertainty and people looking for a bit of a risk-off trade. And I think that's the play for 2018. One thing I almost forgot to talk about, I had a couple of nice little charts that I saw this week on Twitter, and that's this one in particular I thought stood out strongly. And this is the experience of institutional fund managers, and you can see here that more than half of fund managers have 9 years of experience or less. So obviously 9 years is an important number given that's how long this bull market's been going. So March in 2009 was the bottom. So half the people trading other people's money or managing that money didn't experience the 2008 financial crisis, at least on a professional basis. And that tells you something about the level of inexperience in this market and how people aren't used to this sort of volatility. You might see some panicking here. That's an important indicator. And similarly, this is another one that I saw. I think this is a Bloomberg chart, but it's actually the search results for the term "buy the dip," or I assume a Google search. So obviously this week we had the highest number of search results for the "buy the dip." So story count 72 there, right? So almost 50% more than any other week in history. Well, I'm not sure if this is daily or weekly. It probably looks like a weekly sort of chart, but it's 72 mentions there. I assume that measures across the financial media. So when you start to see that buy the dip number come up there, it's sort of indicative that maybe this sell-off's got a lot more to go, because there's still those people. And as I said, there's a lot of traders who have been conditioned to buy the dip for a long time, and eventually that sort of conditioning comes back to bite you. And I think when you're seeing everyone here now that it's not just, they just think it's just another opportunity. There's nothing different this time compared to any of these other moves in the last 5 or 6 years. But I think there's more to go in this. So there are just a couple of interesting charts that I saw as well. And I'll try and put a couple of these. I pick up a lot of interesting charts on Twitter, so I'll try and include a few more of them in future videos.